If you're over 65, Warren Buffett's retirement portfolio for the next 10 years, let me tell you something that nobody wants to talk about. If you're over 65 years old right now, you're entering the most critical financial decade of your life. Not because things are scarier, but because the decisions you make in the next few years will determine whether you live out your remaining years with peace of mind or with constant financial stress. And here's what troubles me deeply. Most people over 65 have no real plan. They've accumulated some savings. Maybe they have Social Security coming in. Maybe they have a pension, but they have no coordinated strategy for how to actually live off their assets for potentially the next 30 years. And that's a problem, a big problem. I'm going to tell you something that might shock you. When I say retirement portfolio, I don't mean a portfolio that just sits there. I don't mean a portfolio designed to slowly evaporate in value. I don't mean a portfolio of low-yielding bonds that barely keep up with inflation. I mean a portfolio specifically designed to generate income while preserving capital. A portfolio that actually provides inflation protection. A portfolio that gives you optionality if you need to access more money in an emergency. This is not the portfolio you should have had at 45. This is not the portfolio you should have designed at 55. This is a completely different animal. And the strategies that work for someone who's 45 trying to maximize long-term growth are actually dangerous for someone who's 65 trying to live off their assets. Let me take you back to something I learned decades ago. A man came to me, must have been 70 years old, and he told me he had gotten it completely wrong. He said his entire life, his financial advisor had told him to buy growth. Stocks, buy index funds, let it compound. He'd done exactly that, and he'd done well. By the time he turned 65, he had about $2 million. But here's where it got tragic. He'd had that money invested in aggressive growth stocks. Then the market crashed. His portfolio went down $400,000 in 18 months, and he panicked. He sold everything at the bottom because he couldn't handle the volatility. He couldn't handle watching his retirement money disappear. He locked in massive losses, and he spent the rest of his retirement in financial stress that never needed to happen. That story haunts me because it didn't have to end that way. If he'd had the right portfolio structure when he turned 65, if he'd understood the specific challenges of retirement investing, he could have weathered that storm. He could have actually bought more during that crash instead of selling, but he didn't know. Nobody told him. His advisor had never made the transition from growth mindset to retirement mindset. And that cost him probably $1 million or more in lifetime wealth. So I want to do something different with you today. I want to share with you exactly how I think about retirement portfolios. I want to tell you about the specific portfolio I would recommend for someone who is over 65 and needs their portfolio to actually support their lifestyle for the next 30 years. This isn't theoretical. This is practical. This is based on decades of managing money and watching people navigate retirement successfully and unsuccessfully. Let me start with something fundamental that most retirement investors get completely wrong. They think their goal is to maximize growth. They think they need the stock market to keep going up, so their portfolio compounds. That's backwards. Your goal in retirement isn't growth. Your goal is safety combined with income, combined with modest growth. You need your portfolio to generate the cash flow you need to live. You need your portfolio to be protected from catastrophic losses. You need your portfolio to have some growth so that your purchasing power doesn't get crushed by inflation over 30 years. These three goals actually require different strategies than the pure growth approach. Here's what I mean. If you're 65 and you need $4,000 per month to live, your first priority is making sure that portfolio actually generates that $4,000 per month. Not next year, not after recovery, but in year one, in year two, even in down market years. That's the income component. Your second priority is protecting yourself from losing such a big chunk of your portfolio that you can't generate that income anymore. And that's the safety component. Your third priority is having some growth so that as you live longer and as inflation erodes your purchasing power, your portfolio can actually grow enough to offset that. That's the modest growth component. Most retirement investors get this completely backwards. They focus on growth and hope income takes care of itself. They concentrate everything in stocks and hope they don't have to sell during crashes. They ignore inflation and think that last year's withdrawal can stay the same forever. All of this is wrong. It's backwards. And if you get it wrong, you can have a perfectly well-funded retirement turn into financial stress. Let me share the framework I use for building retirement portfolios for people over 65. This framework has worked through multiple recessions. It's worked through inflation spikes. It's worked through financial crises, and it will work for you. The first element is income generation. A retirement portfolio over 65 should be intentionally designed to generate income, not growth, income. This is different. You want businesses and investments that actually pay you cash month after month, quarter after quarter, year after year. This means dividend-paying stocks. This means bonds. This means some real estate. If you have the capital, the income component should be sized so that it covers 70 to 80% of your annual spending needs. If you need $50,000 per year, 60 to 80% of that, $30,000 to $40,000 should come from income. That way you're not forced to sell stocks to generate cash flow. The second element is capital preservation. A retirement portfolio over 65 should preserve capital. This doesn't mean zero risk. It means managed risk. It means you're not putting everything into speculative investments. It means you have a significant portion in more stable assets. It means you have diversification so that when one part of your portfolio struggles, other parts can compensate. It means you have some dry powder, some cash or cash equivalents, so that you can weather emergencies without being forced to sell at bad times. A good rule of thumb is to have 1 to 2 years of spending needs in cash and short-term bonds. If you need $50,000 per year, you should have $50,000 to $100,000 in cash equivalents. That way, if the stock market crashes right after you retire, you can live off your cash for 1 to 2 years while waiting for recovery. The third element is inflation protection. This is critical and often neglected. Let's say you retire at 65 with $50,000 per year in spending. By the time you're 85, assuming 3% annual inflation, you'll actually need $92,000 per year just to buy the same things. By the time you're 95, assuming you live that long, you'll need $174,000 per year. That's what inflation does to you. If your portfolio is designed to generate $50,000 and never grows, you'll be broke by your 80s. So you need portfolio growth to offset inflation. This doesn't mean aggressive growth, it means modest growth. It means maybe 20 to 30% of your portfolio in growth-oriented stocks or investments, but you need that growth component so that your portfolio expands enough to cover inflation. The fourth element is emotional sustainability. This is the part nobody talks about, but it's critical. Your portfolio needs to be structured in a way that you can actually live with it. If you have 40% in stocks and the stock market crashes 30%, your portfolio is going to drop 10 or 12%. Can you handle that? Can you stay the course, or are you going to panic? If a 30% stock market decline terrifies you, then having 40% in stocks is too much. You need a portfolio structure that lets you sleep at night. Because a portfolio you panic sell during a crash is worse than a low-return portfolio. Panic and poor decisions will cost you more money than conservative allocation ever could. Now let me tell you about this specific portfolio I would construct for someone over 65. Assuming they have a moderate amount of assets, they need regular income, and they want to preserve capital while maintaining inflation protection. The first component is dividend-paying stocks. I would allocate 25 to 35% of the portfolio to high-quality dividend-paying stocks. These are large-cap companies with long histories of dividend payments and dividend growth. Companies like Procter & Gamble, Johnson & Johnson, Coca-Cola, Duke Energy, AT&T. These are the kinds of companies where you buy them, collect your dividend checks, and sleep soundly knowing that the dividend is very unlikely to be cut. The dividend yield on a portfolio of these companies might be 3 to 4%. That's meaningful income in a retirement context. Why dividend stocks instead of growth stocks? Because dividend stocks have a different return profile. Growth stocks return value through price appreciation. You have to sell them to realize gains. Dividend stocks return value through both dividends and price appreciation. You get paid to wait. If a dividend stock goes down 10% but pays you 3% in dividends, your actual loss is only 7%. Meanwhile, you pocketed income, and if the market stays down for several years, you've been collecting dividend income all along instead of just sitting there watching your losses grow. The income component is psychologically important. It makes you feel like your portfolio is still working for you even when prices are down. The second component is bonds and fixed income securities. I would allocate 30 to 40% to bonds. But here's where I'm very specific. Not all bonds are created equal. I want investment grade bonds with laddered maturities. I want bonds from stable governments and stable companies. I want bonds with yields that actually compensate you for inflation and interest rate risk. And the bond portfolio should be structured so that some bonds mature every year. This creates a natural income stream. Bond interest combined with dividend income should cover 80 to 90% of your annual spending needs. In years when the stock market is down, you still get your dividend and interest income. You still spend from your cash reserve. You don't sell stocks at low prices. You wait. In years when the stock market is up, you still get your dividend and interest income. But now, because your stock portfolio is appreciated, you might actually increase your withdrawals slightly to account for inflation, or you might take gains and reinvest them back into bonds or cash. This is fundamentally different from the withdrawal approach where you just take 4% every year regardless of market conditions. This approach is active. It's intentional. It forces you to generate spending from the safest sources. First, it prevents you from being forced to sell stocks at the wrong time. Let me talk about something critical that most people over 65 completely neglect: healthcare costs. You've made it to 65, Medicare kicks in, you think you're done with healthcare expenses. That's a catastrophic mistake. Medicare does not cover everything. Long-term care is not covered by Medicare. An extended illness could require hundreds of thousands of dollars in out-of-pocket costs. I would strongly recommend setting aside additional capital specifically for healthcare costs, maybe $150,000 to $250,000 depending on your age and health status. This should be in liquid investments that are not part of your regular income generating portfolio. This is insurance. It's uncomfortable to think about, but the alternative is financial disaster. Now, let me talk about the psychological piece of retirement investing, because this is where most people struggle. You've worked your entire life, you've accumulated assets, now you're in retirement. The natural instinct is to become very conservative, to avoid all risk, to hide everything in bonds and cash. I understand that instinct, but it's wrong. If you're 65 years old and you live to 85, that's a 20-year investment horizon. If you live to 95, that's a 30-year investment horizon. That's not short-term. That's not conservative in time frame. That's long-term. And over 20 to 30 years, you need to account for inflation. You need some growth in your portfolio. Being too conservative in retirement can actually be more dangerous than being too aggressive because you'll outlive your money. But on the flip side, being too aggressive is also wrong. If you have a portfolio that's 70% stocks and the market crashes 40%, you're going to lose 28% of your portfolio. That's not just a number. That's potentially hundreds of thousands of dollars. That's years of income disappearing, and you might panic. You might sell at the bottom. That would be catastrophic. So the real answer is moderate. It's balanced. It's structured in a way that you get enough growth to fight inflation, but not so much that you can't psychologically handle downturns. The portfolio I've described, with 40% stocks and 35% bonds and 15% cash, has historically declined around 20% in severe bear markets. Most people can handle a 20% decline without panicking. Many people cannot handle a 40% decline. Here's something important. You need to actually backtest your portfolio mentally. Imagine the 2008 crisis. Imagine the market down 40%. Imagine your portfolio down 20%. Imagine seeing that negative number day after day for months. Can you handle it? Can you stay the course? If the answer is no, your portfolio is too aggressive. You need more bonds. You need more cash. Because again, a portfolio you panic sell is worse than any portfolio allocation. Let me talk about tax efficiency because this matters enormously in retirement. Every dollar of tax you save is a dollar you don't have to withdraw from your portfolio. If you have investments in regular taxable accounts, in IRAs, in Roth IRAs, in brokerage accounts, the tax treatment is completely different. I would recommend a tax efficient strategy that works across all your accounts. Generally, you want high dividend stocks and tax advantaged accounts like traditional IRAs and Roth IRAs. You want bonds and tax advantaged accounts too because bond interest is taxed as ordinary income. You want growth stocks and international stocks in taxable accounts because the long term capital gains treatment is more favorable. I would also recommend considering your required minimum distributions if you have traditional IRAs. At 73 years old, you're required to start taking distributions from traditional IRAs. This is actually an opportunity because it forces you to take distributions and spend money. If your spending needs are covered by RMDs plus Social Security, you can potentially leave more growth-oriented investments alone and not have to sell anything. Now, let me talk about one of the biggest mistakes I see people over 65 make. They completely neglect to update their estate plan. They have a will that was written when their kids were young. They have beneficiary designations that no longer make sense. They haven't thought about what happens if they become incapacitated. I would strongly recommend working with an estate attorney to get your documents updated. Make sure your beneficiaries are current. Make sure your power of attorney and healthcare proxy are designated. Make sure you have a living will. This is not just for peace of mind, this is for protecting your family. Let me also address something emotional that most people don't want to talk about. As you get older, you need to start thinking about the possibility that you might not be able to manage your portfolio yourself. You might get sick. You might become incapacitated. You might develop cognitive decline. It's uncomfortable to think about, but planning for it is wise. I would recommend identifying a trusted family member or a professional who could potentially take over your portfolio management if needed. I would also recommend keeping clear records of all your accounts, all your passwords, all your investments. Make it easy for someone to take over if they need to. Let me tell you something about market crashes and how they affect retirement portfolios differently. If you're 45 years old and a market crash happens, it might actually be good news. Markets are on sale. You buy more shares over the next 15 or 20 years to retirement. You wait out the recovery. You actually make more money from the crash than the recovery. But if you're 65 and a market crash happens, the impact is completely different. You might be forced to sell shares at depressed prices to fund your living expenses, or you might be so frightened that you shift to too conservative positioning and miss the recovery. This is why the portfolio structure is so different for someone over 65. You need to be structured to handle crashes without being forced to sell. Here's my specific recommendation for what to do if a market crash happens after you retire. First, don't panic. The business fundamentals haven't changed. The companies you own are still operating. The dividend-paying companies will still pay dividends. The bonds will still pay interest. Second, spend from your cash reserve if you have one. Don't sell stocks at depressed prices. If you have 1 to 2 years of spending in cash, use that. Third, keep collecting dividends and interest. Reinvest them or use them for living expenses. The income from your portfolio keeps coming even when prices are down. Fourth, remember that crashes are temporary. Markets always recover. This is not the time to give up. This is the time to stay the course. Now, let me give you specific guidance on the 5 stocks in the specific portfolio I would personally construct for dividend-paying stocks in a retirement portfolio. I would focus on the safest, most stable dividend payers. Procter & Gamble, the company has paid dividends for over 130 years. It's raised them for over 60 years straight. The yield is around 2.5%. And this is a company where you can own it, collect your dividend checks for 20 years, and barely worry. Johnson & Johnson. Similar story. Over 80 years of dividends, over 60 years of consecutive increases. Coca-Cola, 100 years of dividends, 60 years of increases. Duke Energy, 100 years of dividends, over 35 years of increases. AT&T, over 30 years of dividends, over 37 years of increases. These 5 stocks can form the core of a retirement portfolio's equity allocation. maybe 20 to 30% of each, depending on your situation. Combined, they yield around 3.5 to 4%. Combined, they provide diversification across different sectors. Combined, they have survived every recession, every crisis, every market shock in history, and kept paying dividends. This is not exciting, it's not glamorous, but it's exactly what you want in retirement. For bonds, I would recommend a laddered portfolio of investment-grade bonds. Buy individual bonds with maturities of 1 year, 2 years, 3 years, 4 years, 5 years, etc. As each bond matures, the cash rolls in. You can spend it, you can reinvest it, you have a predictable stream of capital returns plus interest payments. And alternatively, you can use bond mutual funds or exchange-traded funds. But I personally prefer individual bonds in retirement because you know exactly when you're getting your money back. For international diversification, I would recommend a simple approach, maybe 2 or 3% in an international dividend-focused exchange-traded fund. You're not trying to get rich from international stocks. You're trying to get diversification and exposure to companies outside the United States. Now, let me talk about something that most people over 65 don't want to hear. You might need to adjust your lifestyle. If you've been living on $100,000 per year and you only have $1 million in assets, that portfolio is going to struggle. $1 million generating 4% income is $40,000 per year. If you're spending $100,000, you're eating into capital at a rate of $60,000 per year over 15 years. That money runs out. So either you need to accumulate more assets or you need to adjust your spending downward. This is not fun to think about, but it's better to figure this out now than to run out of money at 85. Let me talk about one more critical thing. Inflation. I mentioned it earlier, but I want to really hammer this home. Most people over 65 severely underestimate inflation. They think inflation is 2 or 3% per year, maybe 5% in an exceptional year. But let's be realistic. Over the last several years, inflation has been much higher, and even assuming 3% average inflation, the math is brutal. If you retire at 65, needing $50,000 per year, by 85 you need $92,000 per year. That's an 84% increase in spending just to maintain your lifestyle. If your portfolio hasn't grown, you'll be broke. This is why you need growth in your portfolio. This is why I recommend keeping 40% in dividend-paying stocks, not for excitement, not for a home run, but for the boring, steady compounding power that offsets inflation over time. A 40% equity portfolio earning 7% per year will grow. Bonds earning 3% per year won't keep up with inflation. Inflation will slowly erode your purchasing power. Now, let me address what I think is one of the most important psychological adjustments for retirement: letting go of growth mentality. For your entire working life, you've been focused on building, accumulating, growing wealth. Now you need to switch to a maintenance and distribution mentality. Your goal is not to build a bigger portfolio. Your goal is to sustain and enjoy your portfolio. Some people struggle with this psychological shift. They feel like they should still be growing. They get envious of friends with bigger portfolios. They take too much risk trying to build more wealth when they already have enough. Let me be direct. If you have enough money to cover your needs, you've won. You don't need to keep playing. You can step back. You can enjoy what you have. Taking unnecessary risk at 65 or 70 to try to become richer is actually foolish. It's like trying to win a game after you've already won. The downside risk is too high. The upside benefit is minimal, except that you have enough. Enjoy it. Let me give you some final practical guidance. First, meet with a fee-only financial advisor or CPA who specializes in retirement. Not someone on commission who makes money selling you products. Someone who is compensated for advice, not for transactions. Spend the money for good advice. It will save you far more than it costs. Second, model different scenarios. What if you live to 90? What if the market drops 30%? What if inflation spikes to 5%? Run the numbers. See if your portfolio survives these scenarios. Third, set up automatic systems. Have your dividends and interest automatically reinvest or go to your checking account. Don't have to think about it. Fourth, automate your spending. Spend the same amount every month or quarter. Don't vary it wildly based on emotion. Here's what I want you to do right now. If you're over 65 and you don't have a retirement plan, stop everything and create one. Write down how much you need to spend annually. Write down what you have in assets. Calculate whether your assets can generate the income you need. If they can't, figure out what to do about it. Either you need to adjust your spending, or you need to work longer, or you need to adjust your portfolio structure. But don't just ignore it. The worst retirement outcome is uncertainty. You don't know if you have enough. You don't know if you'll run out of money. That uncertainty creates constant stress. But if you do the work now, if you create a plan, if you structure a portfolio that's designed to support your retirement lifestyle, you can relax. You can enjoy your retirement. You can travel. You can spend time with family. You can pursue hobbies. You can live the retirement you've earned. Finally, let me say this. I've been investing for over 70 years. I've seen market crashes. I've seen recessions. I've seen inflation spikes. I've seen people get wealthy, and I've seen people get broke. The difference is rarely luck. The difference is usually planning and discipline. If you're over 65, you have a distinct advantage. You have time to plan. You have time to get your portfolio right. You have time to make adjustments. Use that time. Don't waste it. The retirement you create in the next 12 months will determine the quality of the next 20 or 30 years of your life. If this video has provided value to you, if you understand what it takes to build a sustainable retirement portfolio, I need you to do something for me. Like this video, hit that thumbs up button. Let me know you found this helpful, and subscribe to this channel. Subscribe right now, because I'm going to keep bringing you content about investing, about building wealth, about planning for the future. New videos every single week about topics specifically important to people who want to manage their money wisely. Turn on notifications so you don't miss a single upload. Leave a comment below. Tell me your age. Tell me your retirement goals. Tell me what keeps you up at night financially. I read every comment and I respond to as many as I can. This is a community and I want to hear from you. Your retirement doesn't need to be stressful. It doesn't need to be complicated. If you have a plan, if you have a portfolio designed specifically for retirement income and capital preservation, if you have the right mindset, you can enjoy your later years. You can have peace of mind. You can wake up every morning not worried about money. That's the retirement I want for you. That's the retirement you deserve. Thank you for watching. I'll see you in the next video.